Okay, so you can see I've prepared this spreadsheet, and this is a spreadsheet you could prepare. I just did it in Excel in about like 15 minutes. And I'll just kind of walk you through calculating present discounted value, because present discounted value is, fundamental value or intrinsic value. And you should make some attempt in your paper to explore the intrinsic value of your coin, calculate it. And also, you can do some, and I've done it here, some sort of like simple sensitivity analysis. But the first thing that I'll do, and I'll kind of highlight this section just really briefly. Um, and this is the basic intuition, and I'm sure you've heard this before, and I don't know if you can see my little box over there, but it says I lend $100 at 10% interest for a year. At the end of the year, the total principal, which is $100, plus the interest, which is $10, is $110. Or you can calculate that by multiplying 1 plus the interest rate, 1 plus 0.1 times the original principal amount. And that also means that, so if I lend $100, I expect in a year to get back 110, but that also implicitly means that $110 promise a year from now is worth $100 today. And so you can see I did the little calculation here. The present value or the present discounted value, we just say present value and leave out the discounted part, or the PV of $110 received 1 year from today is $100. Or you can take that 110, which is the outcome a year from now, and you can multiply it by 1 over 1 plus the interest rate. So is that intuition clear, Joshua? So you've probably heard that before.
Yeah, that makes sense. Yeah.
Yeah. So I set up this little table, and I have the interest rate, and it's expressed as a simple percentage here. And you can see it increases. There are a couple of scenarios here. And then just to make sure we're all on the same page, I express it as a decimal. So 2% is 0.02. And then I have this little thing. Some people call it the gross interest rate. I just called it the rate factor because I'm going to, use it to multiply stuff. And this is the implicit then discount rate. So I have 1 plus interest rate there. And then you can see this little formula where I'm just calculating this discount rate or discount factor as 1 over 1 plus the interest rate. So it's the same thing I did over in this box, right? And then I have these different time periods. T0 is today, T1 is a year from today, T2, 2 years from today, 3 years from today, 4 years from today, 5 years today from today, 6 years and 7 years from today. And you could carry this out however long you want. One of the things you'll notice, and I didn't do it here, but it's pretty easy to do. If you carry this out to 30 years, you'll be able to see that the discount factor for some period of time in the far distant future, right, actually is very, very, very small. So we could do this really quickly, and I'll just do it right here. I'll say, okay, let's suppose, and this calculation, if it doesn't make sense right now, it'll make more sense in a minute. I'll do 1 divided by 1.1. So that's a 10% interest rate, right? And then I'm gonna take the whole thing and I'm gonna raise it to the power 30, right? So what you'll see in a minute is that tells me that a dollar promised to me, assuming that the interest rate is 10%, that's going to be given to me in 30 years. So it's a promise to pay me $1 in 30 years is only worth about a nickel, a little bit more, say 6 cents today. And so what that tells me is that I don't need to carry my analysis out to infinity, that depending upon the interest rate, cash flows received in the distant future, let's say beyond 30 years, right, are worth practically nothing. I mean, we could take it even more extreme. Let's go to 100 years, and you can see it's like less than a fraction of a cent. So most analysis that's done will only look at, and you could pick the time period for your analysis as long as you're consistent. You could do 10 years, you could do 15 years, you could do 20 years, and that would be fine. So going back up here, you can see the present value of a dollar received immediately is $1. That's no problem. If I'm promised $1 a year from now, right, then again, this is, you can see I calculated the discount rate for just 1 year here, is only worth 98 cents today. $1 received 2 years from today, notice I did the discount factor and multiplied it by itself again, because the interest rate applies to every year. These are annualized interest rates. So I'm gonna discount from a year from now another year if I'm going to do 2 years. So that's where we get the 2 here. Okay, is that clear, um, Joshua? Okay, so maybe the connection's not so good, but I'll go ahead and explain. And are you still on with me, Joshua? Yeah, and who else is here? Let's see. And Leon, can you hear me fine?
I can hear you.
No, I'm here. Sorry, my computer froze on me. Yeah, I was trying to
Yeah,
open
it's
up
a good.
Zoom and tell you. It made sense to me. Yeah. Sorry, I just
Okay,
froze on
okay,
me. I was trying to pull it up.
okay. So here in the third row, basically you can see we've said, okay, well now suppose instead I get an asset that promises me $1 immediately, $1 a year from now, and $1 2 years from now. Then what's the present value of that? And you can see we're just basically adding each one of those individual promises: $1 immediately, $1 a year from now, and $1 2 years from now. And so you can see my formula here. I have the discount rate for the dollar received in a year. That's this first part. And then the one received 2 years from now. Okay. So more generally, so let me escape this. More generally, so we can see that type of promise, $1 every year, and this is actually the calculation for the value of a bond. Normally, bonds, they're assets that pay off a constant dollar value every year called the coupon. So this would be a bond with an immediate coupon payment and then 2 subsequent. So this would be a 2-year bond with an immediate payment, is worth $2.94. It's worth less than $3, right? And this is even more realistic. This is the Treasury issues 7-year bonds or notes, sometimes they call them, at again 2% interest. And you can look at my present value formula, and I'm discounting each one of those dollars according to the year in which they're received. And I'm assuming I would buy the bond for $6.47 immediately today, and then I would get no immediate payoff. But a year from today, I would get $1. 2 years, I'd get $1. 3 years, I get $1, and so on for 7 years. So at 2% interest, that would be worth $6.47 today. So what if we talk about something else like a Starbucks gift card, right? Well, imagine Starbucks has a gift card that when you buy it, you can immediately get a Starbucks drink, right? So here we're moving from assets that pay off in dollars to assets that pay off in, you know, a commodity, something real like Starbucks, because you might have a coin like the, you know, internet computing coin or whatever, that it's not promising to pay any dollars, but it's promising to provide some sort of a service, right? So suppose Starbucks came out with a digital, you know, Starbucks card that promised that you could get a Frappuccino immediately, and then next year you could get one, and the following year you could get one, and the year after that, and the year after that, for a total of 5 years, including the current year. And I put 5 because I don't know about you, but that's about what a Starbucks Frappuccino costs. That's, I take my daughters to Starbucks and they're $5. So again, I just use the same formula, and I'm going to go ahead and discount. And you can see I put in zeros here because after I've used it 5 times, it expires, right? So, you know, again, you might think, oh, well, that's 5 and 5 and 5 and 5. That's worth $25. But really, because again of the interest rate and the discount factor, that Starbucks card only has a present value of $24 and about 4 cents. Okay. So one of the things that I wanted to show you next, and hopefully you're completely on board. So Leon and Joshua, is everything clear so far about what I'm doing?
I think
Yeah,
so.
it makes sense.
Okay. If you guys have any questions, you can just jump in and unmute yourself. So in this next line, the only thing I've changed is I doubled the interest rate from 2% to 4% per year. And so now you can see, because of the higher interest rate, the present value of the Starbucks, you know, you can use it 5 times once a year, goes down. The present value is only $23 and about 15 cents. And here I've doubled the interest rate again from 4% to 8%, and the value goes down to $21.56. And lastly, I doubled it one more time to 16%, and you can see it's $18.99. So as interest rates go down, the discount rate shrinks, and so you know, future promises are worth less. Again, it's the same intuition over here, right? If I want to get $110 a year from today, I just have to put $100 in the bank at 10% interest. So if you're promising to pay me $110 a year from now, that's only worth $100 to me. There are alternatives, and it's really implicitly, and the word you guys might be familiar with is arbitrage. But all of these present value calculations are done based on this arbitrage. Like, you know, if you're promising me $110 from today, a year from today, that's only worth $100 to me because I've got another way of getting $110, right? Which is to put the money in the bank at 10% interest. So that's the intuition behind these present value calculations. Now this one's a little bit different, right? So here, and this is something you could do in your analysis, and we'll talk about it a little bit more, but right, the difference between these bond payments up here is the bond payment pays you exactly $1, but you don't necessarily know what the value of that dollar is going to be, right? Because there could be inflation. And so the purchasing power of the dollar could go down. And here, this is the Starbucks example, assuming that the nominal or the dollar price of Frappuccinos goes up. So it's promising me not $5, but it's promising me a Frappuccino every year. So currently that's $5, but next year it might be $5.50, the year after that, $6, $6.50, and $7, and so on. So now, when I take the present discounted value, again, holding the interest rate here at 8%, you can see that the value of the Starbucks card is more because it's a promise to provide a real good, and I first have to translate that into the nominal price in the period that it's received based on my inflation expectations in order to calculate the present value today of what that promise is going to be worth. Because a year from now, I no longer have to come up with $5 to get a Frappuccino. I got to come up with $5.50. So that promise in dollar terms is worth more because it's covering that price increase. So now here's a little analysis again at 8%, a starting analysis of, okay, Bitcoin, right? So I just picked the current price for Bitcoin that's reasonable based on what's been going on in the market lately of $30,000, right? And now I have to think of some sort of a use case for Bitcoin. Starbucks card, I know I'm going to use it for Frappuccinos. If it was the case that the Starbucks card we were talking about wasn't going to be used for Frappuccinos, but was just a promise for a drink, right? I'd probably have to think about what drink I was going to use and what the value of that drink was before I could figure out what the present value of that promise to get whatever Starbucks drink I wanted each year would be. So likewise, with something like Bitcoin, Bitcoin doesn't promise you anything. You purchase a Bitcoin for $30,000, and then you have to think to yourself, well, okay, what's that Bitcoin likely to be used for? And so I picked, sort of like a popular way in which Bitcoin is used, which is to do international money transfer. And so the scenario that I picked is I said, well, let's suppose the user of the Bitcoin, they're going to purchase a Bitcoin for $30,000, and their plan is for the next 6 years to transfer $5,000 a year to somebody in another country. And if they do that, they obviously they have alternatives. So this is where we think about arbitrage, right? They could, if they want to transfer $30,000, $5,000 per year for the next 6 years, they could go to a traditional bank. But I said, or Western Union, and I'm not saying this is accurate. You all, if you want, you can look up at wire transfer fees, but I'm assuming, and again, you guys would document your assumption, but again, if you give me a data source, I'm not going to question you, not deeply. I mean, this is, we get into the part of the research is documenting your assumptions, and then people could say, oh, well, this assumption's wrong. But as long as your analysis is done correctly, modifying the assumption isn't a big deal. You're more tracing out your methodology and then doing the best you can to find reliable data. I mean, you don't want people to think that you haven't really considered your data sources. But once you, and again, this is sort of what we talked about in terms of like time and efficiency. But once you've tracked down what seems like a good data source and you run with it, you're fine. And again, if you really think the data source is sketchy, you can do some sensitivity analysis. But I'm saying, okay, the wire transfer fee is $300 to transfer $5,000 each year. So I broke this down and I said, okay, well, what if I purchase a Bitcoin for $30,000, then what do I get in return? Well, I get the $300 wire transfer fee that I don't have to pay, right? So that's like income to me. I also get the ability, and hopefully you all know this by now, but one of the nice things, sometimes it kind of fools people a little bit, but the digital currencies, and there may be some exceptions, but all the ones that I've seen can be traded in fractions. So you don't have to trade a whole Bitcoin. You can trade a fraction of a Bitcoin, and that's very common. So if I want to take the $5,000 of the $30,000 Bitcoin and transfer somebody a fifth of a Bitcoin, or in this case, a sixth of a Bitcoin, that's no problem. So I transfer the $5,000 by transferring a sixth of a Bitcoin immediately, because this is T0. And then I do that again next year. And then in after I've done that, 5 times, my Bitcoin's gone in this scenario. So what's the present discounted value of that $5,000 for 6 years at an interest rate again of 8%, and it's $24,963. It's not the full $30,000, right? Because again, I've spread it out, and I've given up the ability to earn interest, leaving that $30,000 in my bank account by buying a Bitcoin instead. But I also avoided having to pay the $300 wire transfer fee. So that's, a benefit to me. That's a cost I didn't have to pay. So I'd get that each year for the 6 transfers too. And the present value of getting $300 for 6 years is $1,497.81. The present value of those repeated transfers for 6 years is $24,963.55. I add them together, and buying that Bitcoin for $30,000 generated, so I would pay $30,000 today. It generated cash flows that are worth $26,461.36 to me. Now, at this point in time, and Leon and Joshua, can you see that there's sort of a problem? Okay, I'm waiting. Hopefully you guys are on board with me. Let's see.
Well, I was following what you're saying.
Yeah. But can you see what the problem is? Leon, can you see what the problem is? So
I'm not quite. I think I'm taking a bit more time because I just got in a little bit later.
Yeah. So the problem is I'm paying $30,000 for something that's only worth $26,000. Do you see what I mean?
Yeah.
Right. So I could explain that and say, well, somebody's still going to pay $30,000 for a Bitcoin only because, there's a bubble, right? They're paying, and again, we haven't talked about whether it's rational or irrational, but if somebody's paying $30,000 knowingly for something that's only worth $26,461, the difference between the price and the fundamental value is the bubble component. That's what people mean when they say there's a bubble. That's a definition. Okay. Do you see what I mean?
Yeah, that makes sense. Yeah, where the bubble's coming from, that difference.
Yeah, because like why would a rational investor pay $30,000 for a Bitcoin if it's only going to generate $26,000 worth of services for them? It's a good question. It's a question you guys should keep in mind. But now I want to show you one other thing. So we assumed an 8% interest rate, okay? And we've been assuming the interest rates just kind of, out of the blue, right? And actually, and this isn't a class on, finance. So, you don't have to know deeply you know, where interest rates and rates of return from assets come from. But you should realize one thing. There's what they call a risk return trade-off. Okay. And so a lot of people say that, you know, assets with high rates of return include a risk premium. So normally it's one of those things where you say, well, you know, you look at an asset, and a bond is a promise from the US government to pay you $1. That's the best promise you're ever going to get. But if you buy a stock, and I don't know, I'll just open this up just a minute, but can you guys think of stocks that seem like they're doing really well but seem risky?
Tesla.
Yeah. So that's one that a lot of people would bring up right away, is they would say, listen, yeah, sure, there's a high rate of return on Tesla, but you know, that's very risky. Tesla stock is volatile. It, you know, does crazy things like responds to tweets from Elon, you know, saying it's 420 or whatever. And so, and not only that, but you know, Tesla's business model itself, there's a lot of questions about it. I mean, one of the big ones is that sure, they were a leader in technology when it came to electric vehicles, right? But is that sort of lead sustainable when they start to compete against BMW and Volvo and Audi and other major auto manufacturers that are catching up and beginning to produce, you know, larger quantities of reliable electric vehicles? You know, can Tesla compete with their scale? And that's a big open question. You know, will Tesla end up, just because they came out with the technology first, doesn't mean that their technology is going to be best, right? And you know, a classic example of that is do you guys ever remember? Because you're too young probably to know, unless you just heard about it in you know, some weird social media post or something. But MySpace versus Facebook, right? So MySpace was, have you guys heard of MySpace?
Yeah, I've heard of it before.
Yeah, well, it was all the rage back in 1989 to have a web page on MySpace, but you know, I think they still have MySpace pages, but I don't even know. And also, like, you guys wouldn't know, but like, you know, America Online was, you know, huge, and you know, I don't think anybody even knows about them anymore. My sister still has an AOL email account, but yeah, being first doesn't mean that you're going to, over the long haul, dominate the industry. So the way that that's normally reflected, and again, if you guys don't know exactly, you can do some sensitivity analysis by looking at, you know, general information on rates of return from you know, different classes of assets, and then kind of, you know, making an argument for which one you think best applies, and choosing a couple different ones. So all I did here is I said, well, you know, Bitcoin's risky, and so maybe an 8% rate of return doesn't really capture the risk. So I increased the risk to 16%, and then I did one other thing, and that is I said, well, one of the things that goes on with Bitcoin, right, is I might pay $30,000 knowing that I'm going to transfer $5,000 worth of Bitcoin for each of the next 6 years, right? But at the end of that, because Bitcoin prices might have gone up, I might end up with some value left over. So this is assuming that over the course of those 6 years, that on average, we end up having a price increase from 30K to 40K. So even though I've transferred $5,000 like I wanted to for 6 years in a row, at the end of that, I still end up with $10,000 worth of Bitcoin because the Bitcoin price went up. And so if I add that into my calculation, So now, and let me make sure this is all calculating properly. Yeah, okay. So there was a trade-off here, as you can see. What happened was the value of that $300 avoided wire transfer fee is worth less now because I have a higher interest rate, right? And also if I was to zero this out like we would expect, right? The value of transferring $5,000, again, assuming that additional risk, the higher interest rate plus the risk premium, right, makes the value of the Bitcoin worth even less, right? Just higher risk. But if the benefit is that I could get $10,000 left over, what I'm calling the capital gain here, at the end of that, that's going to compensate somewhat for the risk. And you can see now I'm still in a situation where it looks like there's a bubble, right? The value of the Bitcoin went up to 26,758, but I'm still paying $30,000 for it. So I didn't manage to, make the bubble collapse by assuming that the price of Bitcoin went up and I was going to have some Bitcoin left over. But I could, right? And so this other scenario down here is exactly the same thing. And I could have typed it in here, but I just put it on separate lines. But now that I've assumed that the price of Bitcoin is not going to go up from 30 to 40,000, but from 30 to 50,000, so I have $20,000 of Bitcoin left over at the end. Now, right, I'm starting to get some alignment between what I paid for the Bitcoin and the value of the Bitcoin in terms of its present value, right? So that's basically the gist of it. And I want to just add a couple of other things here. So I said this is wire transfer fee, right? But I'll ask you all, or you two, right? This is just one scenario for how Bitcoin might be used. Can you guys think of any others?
Well, I mean, could you just use it as a store of value and not transfer it and just hold it?
Well,
That-
yeah, then I would zero that out, right? And hopefully I was going to plan on, I mean, we could do the calculation really quickly. It would be easy. So I'm going to just make this a 0, right? 0, 0. And I'll just do it like this, right? And now these are all going to be zeros too, because I'm not transferring to anybody, right? And then we said at the end, we would end up with, then this is again, at some point in time, are you going to hold the Bitcoin forever? But at some point you're going to sell it, right? So now I'm assuming, right, I bought it at 30. Oh, let me put this one 0. I bought it at 30 and I sell it in, 6 years for 70,000, but there's a lot of risk, right? And now you see a bubble, right, Joshua?
Yeah, I see that.
So, and obviously we could make this go away, but there has to be some end date. So now the Bitcoin price has gone up to $80,000 instead. But, you and I and everybody else, so you could say Bitcoin's, potentially a store of value, but there's risk, right? And I can reflect that risk by putting a risk premium in the interest rate. But there has to be some point in time. I mean, are you going to pass on Bitcoin to your children? Maybe, right? Is that your plan? You buy Bitcoin today, never to touch it in your lifetime, to pass it on to your children? Maybe. But at some point in time, right, you can't eat Bitcoin. So the only reason why Bitcoin has value is because at some point in the future, you're going to trade it in and buy a house, right? Or trade it in and buy a Tesla. So you really have to think, you know, what's the, and even if you say that like Tesla for a while, they were accepting Bitcoin for payment, which I don't think they are anymore. But that just like with a Starbucks card, right? There's something you're going to get that's real that has a price, right? So even if you're expecting you're going to buy one today for 30K and hold it for 6 years and trade it in for a Tesla, and the Tesla's worth 80K, right? At some point in time, you're going to trade in the Bitcoin. Do you see what I'm saying, Joshua?
Yeah.
Yeah, and I don't want to shut you down. Did you have a different take on it, or?
I mean, no, of course you're gonna sell it eventually, but it gets rid of those like wire transfer that you're talking about. I'm just not sure like really what else you can do with Bitcoin because I feel like it's a bit limited. It's more of like a digital wallet kind of currency.
Yeah, and like I said, ultimately, but that's what you have to do when you think through these scenarios. You're trying to value the asset. Eventually, the asset has to have a service or something attached to it where it translates into cash flows, right? And you have to be able to articulate those cash flows. Otherwise, you know, all this present value stuff, it doesn't make any sense at all, right? You can't. And this is what we do in economics. So can anybody else think of, I don't know about you, Leon, did you have any other use cases for Bitcoin that you could think about?
I can't really think of it anything beyond like just the store of value. And I guess like the way you described it for exchanges of like fiat currency.
Yeah, well, how about this, right? I'm part of an oppressed group in Syria and the government is bombing me. And I have assets that I cannot get out of the country. Or I'm a drug lord in Colombia. Do you see what I'm saying?
So it still would be like an exchange of currency, just like illegally, of like illegal goods and services.
Well, yeah, and so it could be illegal stuff, but then, right? If I'm in Syria and let's say I have $100,000 cash that if I try to take out of the country, somebody's going to shoot me on the way out of the country or something, right? If I can put it all into Bitcoin and then go to Germany and then cash out my Bitcoin because I want to move to Germany, then, you know, what's the value of that? Right? Because the reason why I picked Syria is because it's a war-torn country, and I don't imagine most people can, you know, walk into their local bank and do a wire transfer for $300, right? Or I live in Iran and I'm going to flee the country. Or I'm in Afghanistan and I sell heroin to people in China. So yeah, and this is where you have to know about your coin and about how it can be used, because in those cases, right, it's this like wire transfer fee, it doesn't make any sense. It instead there is a transaction fee, right, or what we say a transaction cost. But you know, let's say in order to get, you know, $30,000, I'll just keep the Bitcoin price the same, right? To get $30,000 out of Syria today, so a year from now, I'm going to be in Germany. I'm going to have my $30,000, right? But I'd have to bribe the local officials $10,000, right? Well, if I had to bribe them, then that would mean I would only end up netting, you know, 20,000, right? Well, then we start to, and obviously we got to consider these things carefully, right? So this one here, I'm gonna zero that out, right? So because this is 10,000 that I would pay immediately, right, out of my $30,000, and then I traveled to Germany and I got $20,000 with me, and I want to zero this out because there's no capital gain there, right? So assuming that service is that I paid for is really worth $10,000, which I think a lot of people would, if you pay a $10,000 bribe, you probably don't feel like you walked away with $10,000, but the total present value of those services is $27,241, right? And if it was the case with Bitcoin, right, I didn't have to pay any transaction fee, so I would end up netting, and this is why you have to kind of like walk yourself through it. You'd be netting present value $17,241 after you paid that $10,000, right? And that means you'd get $20,000 when you arrived in Germany. But if instead I purchased Bitcoin, right, and Bitcoin, $30,000 worth of Bitcoin right now, I expect is going to be worth $30,000 a year from now, right, when I get to Germany. But I know that there's a lot of uncertainty. So again, I have a high discount rate here. Well, I'm netting, right, $25,862 as opposed to netting present value that we calculated before, which was the $17,000 present value, right? So for this type of person, since their alternative is basically Bitcoin or pay $10,000 worth of bribes, so in this case, we could add in the avoided bribe fee, right? And so for this type of person, yeah, Bitcoin starts to make sense, right? I avoid that $10,000 bribe. I buy $30,000 worth of Bitcoin. I have $30,000 worth of Bitcoin a year from now. And so the present value of that transaction is $35,000. It's more than the price that I paid for the Bitcoin. You see what I'm saying? So,
Yeah.
so you have to walk through these scenarios and explain what you're doing in your calculations carefully. But these were avoided wire transfer fees. This is an avoided bribe fee, right? Which is a value to the person receiving it, right? And then this is kind of like your store of value, right? You get $30,000 Bitcoin. But again, it's not as attractive as it seems. You don't avoid the bribe and for sure get everything back. But in terms of present value, even accounting for the risk, assuming that 16% is sufficient, if you thought instead that the interest rate was higher, right, or the discount rate should be higher, if it was better to put in 30%. And these are just text boxes here. To get everything to change, I gotta change the decimal value. I put 0.30 there. Then still it looks good, right? But at some point in time, if you think Bitcoin is a super risky store of value, it's going to be better to pay the bribe. We could bump it up to, let's say, 0.5. Oh, looky there, right? That's our break even, where we're indifferent between, you know, buying Bitcoin and not. But at some point in time, it'll be better off to pay the bribe, is the main point. So you might wonder to yourself, and kind of like a second part of the analysis. So I'll ask you all, do you guys have any questions right now? Because I'm gonna transition to something a little bit different in a minute. But is this kind of stuff clear? Because I think you can do all this. You know, the hard part is, you know, figuring out what is the value of the service that your coin provides. When you have that coin, what is it really entitling you to, right? Does it help you avoid a wire transfer fee? Does it help you avoid a bribe? Does it help you, you know, use some computing assets that have value? Is it like a Starbucks card? What's it really do? And you had asked a little bit about the value proposition stuff, Joshua. And I don't know if the role of the value proposition is starting to become clear, because really it boils down to, you know, these ideas of, you know, what's the service that the coin provides and what's the value of that service.
Yeah, I see how that ties in now. Now we're going to be using that to figure out, like you said, that value.
Okay, so I'm going to stop sharing this. So one of the questions I had was, okay, so we have these people potentially in Syria or drug dealers in Colombia that don't have any other way to move their money. You know, this is one person. Does that use case translate well into, you know, what we think would support a price of Bitcoin for like $30,000? And kind of the next part of that. So this is a use case, but part of it too is we have to think about how many such people are out there, right? One person who's willing to pay $30,000 for Bitcoin does not make a sustainable Bitcoin price, right? That's just one person that would be willing to pay that price. That's not, you know, the whole market. So this is kind of what we call a stock and a flow problem in economics. The flow is like the single transaction, and then the stock issue is the stock of value. So I'm going to stop this share and I'll show you something else which might be helpful. So I looked here for the market cap of Bitcoin. And if you should understand, because all of your data will have market cap in it. Market cap is just the number of Bitcoin outstanding, right? Number of coins times the current price of the coin. This is an estimate. It's in billions of dollars. So this is saying that the total market cap of Bitcoin is about $1 trillion. So at current prices, now this one is from May 11, 2021. But again, I don't want to go back and look exactly what was the price of Bitcoin then. It was probably higher than it is right now. May, yeah, it's probably higher than it is right now, because the price of Bitcoin's dropped recently. But you could figure out what was the price that supported this market cap if you just did a little bit of digging. But about $1 trillion. So then our next sort of question should be, well, are there, you know, $1 trillion worth of assets that people that are in the situation of our Syrian refugee would be willing to pay? Would there be lots of such people that would support that $30,000 price? And so one of the ways you can get at that is you can look at GDP by country to get an idea. Remember, the GDP is going to be the income, right, of the country, and in a given year. So this is nominal GDP in 2017, and it's not the published by the World Bank. This isn't the most recent data that's available, but I'm just using it for sake of example. But you say, okay, there's $1 trillion worth of Bitcoin out there, and people are buying Bitcoin. Could they buy $1 trillion worth of Bitcoin? Well, you start to look at, in 1 year, there's about $20 trillion worth of income generated in the United States, about 12 trillion in China, and so on. You start to say, okay, well, yeah, it looks like there's potentially enough, possibility. And if you really wanted to dig into this a little bit further, then implicitly what we're calculating, so folks here with GDP, remember from principles of macroeconomics, it's C plus I plus G, and then there's net exports, but consumption plus investment plus government expenditures. And the critical piece of this is, remember, consumption is what people are purchasing in terms of food, clothing, what they're spending on rent, stuff like that. Well, I don't think much of that's going to be diverted to purchasing Bitcoin, right? And government spending, the government's not going to buy Bitcoin, so we've got to exclude those. Really, what's available to be used to purchase assets is the I component, which is the investment. And you might remember also from macro, there's a simple relationship that in a closed economy, investment is equal to savings, right? So our savings would be a fraction of this, and you guys could look up, but if we started to look at global net savings or savings by country, we could get a better idea of whether or not that sort of basically cash flow is widely available. And then I thought another really interesting chart to look at was on global wealth. So again, global wealth is a stock concept. Savings is how much you're saving today, right? And that's going to contribute to your future wealth, right? But here you can see total savings. The United States is 105 trillion, China 68.83 trillion. But the types of folks that we talked about in our scenarios, right, are like the folks here living in Iran, and they have 0.76 trillion, right? Again, we're just trying to see if the use cases that we're pointing out, which are people sort of like in desperate circumstances, people living in war-torn countries and the rest of it, could possibly have enough assets that they could trade in their stocks or their bonds or sell their business or something like that and push that into Bitcoin because they wanted to use it for some purpose that if they were to try some alternative channel, they might end up in jail or have to pay a bunch of bribes and stuff like that. So that Bitcoin would actually be a better alternative. And I think given that the market cap of Bitcoin is about 1 trillion, and just eyeballing the data that we see right here, it doesn't seem implausible that there could be enough sort of desperate people around the world with enough wealth that they're trying to transfer that couldn't support a $1 trillion market cap for Bitcoin. Now, again, if you're working with a different sort of coin that has a different sort of mission, that is something other than just a pure store of wealth, because Bitcoin doesn't promise you $1. It doesn't promise you any other service. It's just an ability to get your Bitcoin wallet and have your money in that form, or hold your wealth in that form, which entails a lot of risk, but potentially is less risky and less costly than alternatives for other people in what we might call desperate circumstances. But that's the type of thinking. And obviously, if I was writing a paper, you trying to justify the fundamental value of Bitcoin, I would do some more investigation into, exactly, what are the market for potential people. Try to do a better job of estimating, a fraction of the global population that was in the situation where, and it might be a fraction of a 0.5%, but even if my number was off by an order of magnitude, once I did my calculation, again, that's an assumption that I documented. I would document my data. And other people could question it, and that would be a way of advancing the field. But at least people would know, oh yeah, if I said that there were 0.5% of global wealth that could be potentially held in Bitcoin that could sustain this price, then people would know it wouldn't take 10% of global wealth, or 50% of global wealth, or 100% of global wealth. See, the magnitudes matter. They would be able to put into perspective the $1 trillion market cap for Bitcoin versus the, it looks, I don't know, I'm just eyeballing it here, but potentially, $200 trillion worth of global wealth that exists in the form of all assets. So that kind of benchmarking helps to show that maybe my analysis is onto something. When I do something like say, oh, I've walked through these use cases and these scenarios, and yeah, I can make up a story about somebody that lives in Syria being willing to pay $30,000, even though Bitcoin is super risky, right? Or somebody that thinks that there's going to be a capital gain from Bitcoin in a couple years that's reasonable, and I'm getting something close, and that Bitcoin can be used for transferring money, and they can avoid these wire transfer fees. When I do all that kind of stuff, then right, I can put it in perspective and say, okay, I can look at the market cap for this coin, and my use cases begin to seem more plausible potentially. Or in your investigation, maybe you draw out these use cases and you find out that there's no reasonable data, there's no reasonable justification for how there could be a $1 trillion market cap for your coin. That might happen too. But all of those things you should draw out in your your conclusion and your writing. Okay, so I'm going to stop sharing, and I'm gonna ask really quickly, do you have any questions for me? No. Okay.
I have a question. But it isn't.
Okay. It's okay. It's very specific. Then I'm going to stop recording. Okay.